You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. You wanted it, you got it. A radio program that helps teach you options trading inside and out, basic to complex. This is Options Bootcamp. Whether you want to learn how to protect your portfolio, generate income, or even become a master of volatility, the Options Bootcamp drill instructors will break it all down for you. Now, let's get you into peak options trading shape. Here are your Options Bootcamp drill instructors.
All right, everybody. That music means it is time once again for Education Wednesday. And it's time once again for our premier educational program. Yep, it is time for Options Bootcamp. My name is Mark Longo from theoptionsinsider.com, as well as, of course, from the ever-exciting, at least we tend to think so around these parts, Options Insider Radio Network. Love all you folks out there on demand. Options Bootcamp continuing to tear up the charts every month this year so far on the network has been a record. So we thank all of you. A lot of you folks loving Options Bootcamp. If you're one of our many on-demand listeners, then all we ask is, hey, if you like what you hear, keep rating and reviewing. It clearly does help new folks continue to discover the program. We just had our big 200th episode extravaganza. I've been doing this show for over 10 years now, over a decade. Hard to believe when we say it out loud, but the new people discovering it all the time. You can help with that process. So if you like what you hear, keep rating and reviewing, just like our friend Exley did this week, leaving us a 5-star review saying this show really scratches the options trading itch. Check it out. Well, thank you. We endeavor to scratch that itch every week there, Exley, so you too can leave a review on your platform of choice. And of course, if you need more in your lives, and who can blame you, you want to go above and beyond a couple of shows that are hitting you a day here on the network. You want to get, let's say, exclusive pro Q&As with some of the best minds in the world of options and derivatives. And, of course, unusual activity breakdowns for the entire week, including some live trading where we get into all sorts of fun trouble. And, of course, live access to this, every other show we do throughout the week. And, indeed, giveaways. Just gave away a big pro trading crate to one of our pro members out there. Those are awesome. Those are fun. No small effort on our part and expense to put those together. But we like you folks, so it's worth doing it for us. How do you get in on all that action? Theoptionsinsider.com/pro is the place to go to join us on the dark side. And speaking of the dark side, joining me once again on the show this week, the black-hatted one himself, Mr. Dan Passarelli, the founder of Market Taker Mentoring, the author of one or two options-oriented tomes. Mr. P, welcome back to the show, sir.
Hey, Mark, it is super great to be back on the show. Looking forward to it. I think we got a really good really good episode today.
We got some class, but we got an even better guest, I think. So let's get to it. Get to bust out a drop. We don't get to use that often on this show. We forgot we had it, Dan. Yes, listeners, it is time for the roll call.
Roll call! You boots listen up while today's guest speakers are announced.
All right, every day, 4th of July here on Options Bootcamp. Welcome to the roll call. Yeah, we haven't tried this one out in a while. Usually it's Dan and I holding court here on some options topic, but we thought we needed to go above and beyond for today's topic. It's an extra special topic. That means an extra special guest, our old friend on the network, my partner in crime over there on the advisor's option, making his first appearance on Options Bootcamp, Mr. Matt Amberson, the founder and CEO over there at ORATS, a.k.a. Options Research and Technology Services. We call them around these parts, the Oracle of New Hampshire. Mr. Matt, Welcome to Options Bootcamp, sir.
It's great to be here with my old friend Dan, and looking forward to it. This is a great show. I listened to it, and now I get a chance to be on it, so this will be fun.
This will be fun. So, yes, we thought we'd bring you in today, Matt, because we are talking about a topic that is pretty much right up your alley. In fact, many years ago, I strong-armed you into creating some reports along this area for our audience, and lo and behold, it has become a very interesting area of research and analysis for you and your team. Of course, I'm talking about what's happening right now. We are all in the midst of it right now. We're trading options during earnings season. In fact, Mr. Matt, a little birdie told me you were just in our neck of the woods not too long ago here in Chicago doing a panel on this very issue. So why don't you break it down for us? What did you come to Chicago to talk about? And give us your overview, your thoughts on all things trading options during earnings, sir.
Wow, your tentacles really get out there. I did actually give a presentation at the Chicago Traders Expo.
My spies are everywhere, sir.
Yes. And we've come up with this technology to do these automated videos, and we use our dashboard product to go in and figure out what are the liquid stocks that are about to announce earnings. And we have all sorts of fun information in the dashboard product, including a 12-week or a 12-quarter history of earnings that have happened, and it shows what the implied move is in kind of a 2 inches on the screen, and there's a dot in there wherever the actual earnings landed, so you could see how many times that stock has beat the earnings expectation from the straddles, and how many times it's been inside. Every time it beats is approximately profitable for a long straddle, and every time it's inside, usually profitable on the short straddle. So we show that, and then we use our option scanner to pick out what is the best theoretical trade that's out there right now, using our expectations of earnings moves and our forecast of volatility. And so we'll get calendars and straddles that come out, and then we'll break down that option, and we'll look at the payoff picture, and we'll look at the max loss and max gain over a 3 standard deviation. So that's basically how we're breaking down earnings and that was this big speech at the conference. So, and it was well attended, and even though I paid people to give me a standing ovation afterwards, it didn't happen. But we got to play a golf clap out.
Did the heckler I paid? Did he show up? Did he throw the tomatoes? I paid extra for the tomatoes. Did he hurl those at you?
No tomatoes, but the 3 people I said, okay, standing ovation afterwards, in joking. I didn't quite get that. I was hoping for my first standing ovation ever. I know you've had millions of standing ovations, Mark.
They get old over time, yes, but they are fun. The first time, you never forget your first standing O. So I want to run down some things because we get inundated all the time with questions about this. In fact, that was kind of the genesis of my talking to you about this years ago, is because we just got this particular question all the time from people. They see earnings are happening, earnings are popping off, earnings season, always a volatile time, always an interesting time. There's always at least a handful of names that are making news and causing big disruptions, big waves in the market. So people want to know how to approach it. So the $10 million question everybody asks earnings season, they want to know long premium or short premium. I know we've crunched the numbers on this over the years. What do you tell people when they ask you that, sir?
So just a back step, one or two. So we first came out with this earnings report that looked at historical straddle prices versus the past earnings move, the average past earnings move. So you could do that comparison, and then and you were happy with that, but we thought we could do better. So then we said, well, why don't we use this data, or at least this, what I did is went back historically and said, okay, we have all this data that's associated with with the options earnings report that we put on, at your urging. We have the 30-day implied X earnings, so that ratio. We have historical volatility over the last 90 days and the historical volatility X earnings. So and then of course what I mentioned earlier, the past earnings move versus the straddle earnings move. And what we found is all that data is important. And we use those ratios now to identify times to put on, various strategies. So our strategies are, after Dan, of course, we had to put the long calendar in there, as he's made that famous, and then the short straddle and long straddle. So what I did is went back, thousands of trades, what would have been best under what conditions. And so now what we're doing is we have a report that comes out that will look at, all the, hundreds of names, I guess now that are reporting this week, and goes through and says, okay, what are the conditions right now? Is it better for a calendar, a straddle, buy or sell? And so we've gone through all the testing, and the testing came out well, over a % per trade, which is very good for a 1-day return. And then we've been testing now for, I think this is our 4th or 5th earnings quarter out of sample. So you're expecting a little bit less, and we have a little bit less, about 40 basis points lower than in our training sample. So not too bad. So we're still about 2/3%, 66 basis points of profit on our calendars. That's been the best one. So we had selling calendars, but that didn't really pop off a lot. I've taken sell straddle off because I don't want the big moves against our people. So we just have buying calendars, essentially selling vol, at least in the front, and buy straddle. So that gives people something to do most of the time. So to answer the long-winded answer is the buy straddle is about a break even. But the calendar, again, as Dan has pointed out many times, is the profitable strategy around earnings, at least when we're figuring out these points in time when it's most advantageous for these types of strategies. So yeah, we've done this back test. We've been testing it out of sample. So when you get the earnings reports now, you'll see the out of sample and the in sample and any trades that came out that they're signaling today, and then the trades that signaled the prior trading day and how you did. So it's a lot of fun to watch, and even dabble in there once in a while, Mark.
Lots of fun to dabble out there. Of course, these reports he's talking about, listeners, you can find them all over there. TheOptionsInsider.com. Click on the Options News and Articles tab. You'll see them all there. We'll go over all of them in much more detail in a little bit. But he mentioned, Dan, how you like to use calendars. You have a very specific approach that you like to take to earnings season. So why don't you break it down for our listeners, and how did you arrive at this particular approach?
Yeah, Mark. So this is an approach that, I started developing probably in about 2017 or 18. And kind of been perfecting it ever since. In fact, when our student traders end up joining our class, I give them like an easy spreadsheet to track everything in. And I tend to make changes to it every quarter. It ends up being sort of this evolving strategy, which is kind of cool because when you get really, when you just intensely trade something for like 4 weeks in a row, and that's like all you do during that period, 4 to 6 weeks in a row, you just end up learning something every time around, and it just kind of gets better. But, the gist of it, well, one of the important things that Matt pointed out, who's done tons of research on this, is that we want to compare basically the break even of a time spread to how big the moves have been in the past to see if it makes sense to trade them. And then, in my presentation where I talk about time spreads and sort of introduce the concept, my online training, I say about 95% of the trades are time spreads, and about maybe 5% of the time is straddles or something else. We've probably like 4.9% of the time is straddles and 0.1% of the time is something else. Because when the time spreads don't model out, that's when I go with the straddle. Basically, if historical prices gave too much movement in the past that would render a time spread not practical, maybe a straddle makes sense, and then I just model those out as well.
So let's talk about a setup that you like, Dan. So you come into earnings season, you're looking for some time spreads. We talking about your traditional, maybe going out, 2 months, buying that at the money and then selling the 1 month? Are you looking to do them in the weeklies? What is your typical setup for an earnings calendar?
Right. So the important thing is, here's really the crux of the whole strategy, right? It revolves around term structure of volatility, because when implied volatility goes up, well, actually, let's back up the thought iteration process here, right? When people come in to buy options because they expect volatility, whether that's to hedge existing stock positions or buy straddles, people will very commonly buy straddles going into earnings, which Matt pointed out is a break even. I know that in the past, your data showed that it was actually a loser. Earnings have gotten a little bit more volatile over the past several quarters. But moral to the story is, when people buy options, it drives up the implied volatility, the cost of those options, but not the same for every option, right? If Apple has earnings coming out after the close today, and your typical run-of-the-mill option trader who hasn't seen some of the research that Matt has done that's on the Options Insider website, they come in and buy straddles. What they tend to do is they tend to buy the very shortest term straddles. And why? Because price-wise, just dollar-wise, they cost less, so they're risking less. And they're not really worried about theta because it's just a one-day play. They want that really high gamma that comes along with those front options. So those front options that expire somewhere between 1 to 4 days before earnings actually comes out, those get just jacked to the moon when it comes in terms of volatility. So then the next logical question is, well, which one do I buy? And that's where it's a little bit tricky. What I'll tend to do more often than not is, if I'm looking at an earnings trade that has weekly options, I'll sell that front option, but then I'll buy the monthly option because they tend to have more liquidity. They have tighter bid-ask spreads, more open interest, more volume. But the best thing to do is to model out all the different expirations out there and select the best one. Basically, you want a pretty big disparity between the implied volatility of the option you're buying versus the one that you're selling. And that's kind of why this this handy little spreadsheet I came up with makes it so simple and so less time consuming to do, so you're not doing all that manual work.
Matt, Dan mentioned how earnings have evolved a little bit. It has been a fun process ever since we started tracking it, particularly with the onset of the pandemic back in March of 2020. All of a sudden, earnings and earnings volatility became a very different beast than it was before that. Why don't you walk us through that a little bit? Because you've been tracking this data for some time now. How has earnings evolved, particularly in the last few years post-pandemic, Matt?
Yeah, so you bring up a great point. And another report that we came out with was the earnings season report. What it basically does is it breaks the earnings season into 6 weeks, as Dan mentioned earlier. And we say, okay, what were the expectations of the move for all the stocks that reported on week one, and what actually happened? So maybe what we found in week one is it wasn't a very good week to own straddles. So that was maybe 90%, let's say. And then week two, we do the same thing. And that was a little bit better, maybe 93%. So meaning you'd pay $1 for all those straddles and you'd get back 93 cents. And then the third week was better, and the fourth week was the best. Fifth week was okay, and then the sixth week kind of were all the stragglers. So we would really watch what was going on. And when we started this, I don't know, God, how long was it? 4 years ago, maybe a year and a half pre-pandemic, something like that. It would always be around 95 to 100%. So you'd break even. We'd model these at trading the mid market. So then, right when COVID happened, we noticed that the volatility got so high that the earnings that were being implied, the moves were so large that none of these firms were making that amount. Meaning, and so the average started going down into the 80s, which we had never seen before, and we were wondering when earnings was going to be meaningful again, meaning when you could really buy a straddle and the stock would move more than the expectations. And it really took until quite recently to where, and now we had our last earnings season was the biggest earnings season versus expectations. So, you could attribute that to a lot. It's not only just the amount of volatility in the market, but it's the amount that people are really paying attention to earnings. And I think this is going to be a pretty big earnings because, a lot of people are expecting this, raising rates to start to impact the amount of earnings companies are reporting. And so people are looking a lot more closely at it. I think what happened before was that people were looking more at macro events or, things around COVID. And now they're starting to come back all the way around and start to look at stocks again. So what we're seeing is, especially the last earnings season, we saw, a lot higher percentage move compared to expected move. So straddle owners actually made some money last earnings season. And it looks, my expectation would be that this will be a good one for straddle buyers as well. Mark.
Yeah, it's going to be a fascinating one because you're right. The last season was quite the banger, the most volatile season we've seen since we've been really running these numbers. I think the season ended up averaging out somewhere around 115%, something like that, Matt. So that meant, listeners, as you said, if every name pretty much performed up to their straddle and that was it would be 100%. And as Matt mentioned, during most of the pandemic, it was actually much lower. It's usually in the 80s. And this one was about 115%. So dramatic outperformance across the board. We're just starting this new cycle. It sounds like Matt's expecting a little bit of a banger out there as well. Let me run down really quickly again what those reports are. So if you're listening to this, you're saying, what kind of data can I really sink my teeth into for this? And you really need to thank Matt and the team at ORATS, because for years we were inundated with these questions about earnings season, and there was no data available. There was one Goldman study from about a decade ago about buying and selling straddles around earnings season. And that was about it. And it was hardly definitive, and it was hardly updated. It was old. And so, again, I kind of strong-arm Matt into doing. I think we're all very happy that we did now, because now you guys have a lot of great data, real hard numbers at your fingertips that you can look at. And that comes in the form of 4 reports that we put up on the website. There are even more that Matt has over there. I'll let him tell you about those in a second. But as you mentioned, there's the start off is the earnings move report, which kind of looks at all the upcoming names that are going to announce in the next week or change and tell you exactly what they're pricing in from a straddle perspective, how they performed in the past, and a variety of other metrics they put in there so you could see, gives you some frame of reference for how they performed in the past. Then there's the earnings move results report, which of course shows you exactly what happens immediately after the announcement, trying to really quantify that earnings crush, that crush that happens in the vol right after the announcement. And then, of course, there's the earnings season report, which we just talked about, which takes everything we track throughout the 6 weeks of earnings season and breaks them down into a percentage in terms of the actual movement, the actual vol we're seeing out there. And as Matt mentioned, we have a new addition to that, which is the earnings trades report. I think we're tracking somewhere right now around 92 long straddles and somewhere in the same ballpark of long calendars for you out there. So you can see the entries, the exits, how they performed, all that good stuff, and a whole bunch more. TheOptionsInsider.com. Click on the Options News and Articles tab. Because you love you folks, it's all there available for you right now for free. Just click on the link. If you're even remotely intrigued about trading options during earnings season, or if you even wanted to see what's causing all this havoc, all this noise, all this volatility that I'm seeing in a particular name, you could see all that data out there. Matt, did I get them all, or am I missing a few?
That's all of them, Mark. And they've been aging for quite a few years now. So we're happy to have them up there, and people could just watch and follow along, or get some value out of it. But then what we're doing now is we have this automated video that and blog that comes out. So it goes through, a single name on most days in the busy earnings season, and it'll break it down, much like I spoke of at the beginning of the show with the presentation that I gave, was based on one of those automated dives into a single name where they go and look at all the history and where the straddles ended up over the past 12 earnings cycles, and then what the best theoretical trade to do is. We look at it a little bit differently than Dan does. We just go in for the calendars, for example. We look at the first 3 to 6 weeks and try to find the sell. What has our best? We do a whole evaluation of the volatility surface, and then we go out from 3 months to even 6 months and try to find the best buy theoretically, and that becomes our calendar. But that's how we go about those single name deep dives, Mark.
It's a lot to talk about with earnings. I'm looking forward to hearing from you folks after you check out these reports. Maybe hit us up with some of your own questions. This is how I like to approach trading options during earnings season. Maybe you avoid it. Maybe you're one of those people who says, if I have a name that's about to announce, I don't go anywhere near it. That's certainly a viable strategy, especially for a lot of newcomers out there who may be just dipping their first toes in the world of options. Earnings season can be rough waters if you haven't been through them before. Dan, anything else you want to add about trading options during earnings season before we get some of the listeners on the show, sir?
There's some nuance to it. And, if you end up trying out some of the things that we're talking about here, don't get discouraged. There's some nuance to it, and there's some information that, Mark has and that Matt has and that I have. And I think you put some of this stuff together, and this is something that you can make a little trading business out of.
Yes, you are no longer going blindly into the darkness of earnings season. You are now armed with great data and information. So take advantage of it as we see what else you folks have on the brain. A little bit of the old mail call.
Mail call. Time to look at questions submitted by our listeners.
All right, everybody, welcome to the old mail call, the portion of the show where you guys ask us questions. We also turn the spotlight back on you with our questions of the week. Let me pay off last week's question of the week before we dive into this week's. We've been debating for a while on the network, do we need VIX to really spike, pun intended, to a higher level to signal that there's concession in the broad market, to really find a bottom in the broad market? Back in May, we asked you that question, and about 43% of you said we needed VIX to spike to over 40 before you really felt comfortable buying in on this market. So we thought it was time to revisit that last week. We asked you quite simply again, what level does VIX need to hit to signal the bottom in the market? VIX north of 40, north of 50, north of 60, or no spike is necessary to signal the bottom in the market. And that ended up winning with 42.5%. Those folks saying, we just don't need that. We're not buying into that theory anymore. 31.3% saying, yes, you do need a spike and it's north of 40. 15% saying north of 60. Maybe they're playing in some of Matt's garbage VIX calls there. And then north of 50, 11.3%. This week, we asked you folks another question. We've been tracking a lot of our data from our questions of the week, and sometimes it's fun to revisit them to see how your viewpoints evolve over time. At the beginning of the year, our first question of the week this year, back in January, we asked you if you had to buy a 10% out of the money call on one of these following underlyings, which one would you choose? Of course, expiring at the end of the year, December 31st. So effectively buy a 1 year, 10% out of the money call on one of these four underlyings. Which one you choosing? We gave you VIX, Bitcoin, WTI, so crude oil, or the SPX. And back in January, 34% of you chose the SPX. Remember, back in January, SPX was at about 4,600. So north of 1,000 points of above where it is right now. And you wanted another 10% on top of that. So that's an interesting thing. Hey, it could still happen. This is a crazy year, but intriguing stuff. So we thought it was an interesting time to revisit this question. Again, 10% out of the money call expiring December 31st. Which one of these four are you choosing? VIX, Bitcoin, crude oil, or SPX? Mr. Matt, we'll start with you, sir. First off, what is your vote if you have one? And then B, more importantly, what do you think our audience is voting for?
So let's see. I mean, right now, I'd probably go Bitcoin with it. You know, I think by the end of the year, is that where we're going, Mark?
That is where we're going. Yes. So it only needs about 1,900 points.
Yeah, I'll do Bitcoin. I think obviously, I think people were picking SPX back then. I think they'll probably pick SPX now. You know my feeling on SPX. I think that what's going to happen is this is going to be a protracted bear market. On the show, on the advisor's option at least, I was calling for 3,000. I'm still comfortable with that, anywhere between 2,800 and 3,200 at the low. I think what's going to happen, we have earnings per share of about $234 for the trailing 12 months for S&P. I think that's going to go down with the rise in interest rates, and it usually takes about 12 months for that to bottom and start to turn up again. So, and I think it will be about at least 10%. So I think, using a similar PE, about 16 and $200 per share, I think that the SPX is probably going to get down to about between 2,800, 3,200. And I agree on the VIX. I agree with the audience. It doesn't really need to do one of those blowouts. I think it's going to be a protracted bear market. That's just going to eventually turn when the valuations get to a certain level, and when earnings start to turn up. So that's my feeling on those, Mark.
Interesting. So you're picking Bitcoin. You think the audience is picking SPX, even though you think SPX headed for more dark days to come. Mr. Dan, same question for you, sir. What are you picking? What do you think our audience is picking?
Man, I'll tell you what. I mean, I look at these and it's kind of like, which reality show do you want to watch? Like, I don't want to watch any of them, but if I have to,
you're a Housewives guy. We all know it.
Yeah. I mean, I don't see VIX being there. I don't see SP, the SP 500 being there. I don't necessarily see crude going there unless something crazy comes along. I'm not really sure if I see Bitcoin being there, but I guess if I had to pick one, I'd either say something could possibly happen to drive crypto higher just in general. Or there could be like a specific event that drives crude. And those things are not possible to predict. So I don't know. I mean, I guess I'm going to jump on Matt's bandwagon a little bit with Bitcoin, not because I feel like it's, an incredible investment, but just relative to the other ones by the end of this year, that's probably what I'd be looking for. I mean, I bet that this would be pretty split. I think we would see not too much between maybe 10 percentage points between the low and the high if we get to see these results.
So just to read between the lines there for Dan, he's a huge fan of the Real Housewives, and he's all in on Bitcoin, listeners. So there you go. That's what we got from that list. Let's see what you folks are up to right now. Still have a couple days left. At Options is the place to go to make your voice heard, listeners. If it's not pinned, a lot of times we have a lot of content hitting the network all the time, listeners. So that's going to push it down a bit. So sometimes other stuff's pinned at the top. Just scroll down a little bit. You will find it there. Our question of the week, or just search for hashtag question of the week. It'll be there. Right now, 41.4% are choosing the SPX. Interesting. You're talking roughly a 360-point move you need in the S. We could do that. That certainly can be done. WTI coming in number 2, 37.9%. So you're talking roughly a 9-point or so move in WTI right now. And then you're talking Bitcoin and VIX, both tied at 10.3%, which is interesting. Bitcoin, like we said, needs about a 1,900-point move. VIX is hanging out a little bit north of 30, so somewhere in the ballpark of a 3-point move there. So VIX could certainly do that. Of course, the question is, can it maintain? VIX spikes tend not to last very long outside of the aberrant ones. So can it maintain it through all the way to the end of the year? That will be the interesting question. Speaking of questions, you folks have them on the brain for us this week. Let's see how many we could squeeze in here. Let's go out to Aaron. Aaron first. He says, hey, guys, loving the OBC. Well, right back at you there, Aaron. He says, I'm learning more about straddles. it seems like they are polarizing positions. That's a good way to describe them. Straddles are deeply polarizing. And when I first learned about them, they seemed like no-lose trades. You just buy them and sit back to print money wherever the stock goes. But as I've learned more about them, I'm starting to learn about the downsides to them. So I guess I'm asking, when do you guys like to trade straddles, if ever? Oh, if you'll recall, I think it was back in early 2021, so early last year, back in this explosion of the meme stock madness, market was rocking and rolling. And all of a sudden, we were talking about long straddles a lot on the network. I remember Dan was going on about them. Brian on OPR was talking about long straddles. And that was just deeply surprising to me, because if you listen to our content, you know, we never really go out and talk about, hey, maybe it's time to buy a straddle. That just shows you, A, how crazy those markets were, and B, the kind of conditions you really need to make a long straddle pay off. It really needs to be a lot of bang for your buck really quickly. You do not have time to screw around with a long straddle, because you're long two at-the-money contracts. And as we all know from listening to this show, the Greeks, the theta is highest at the money strikes. So you're just seeing two contracts decay extremely aggressively every day. So you could be right, but if it takes 10, 20 days to get there and you have a 1 month contract, by the time you get there, you need even more of a move just to break even. It may be too late. So you need extremely volatile, extremely aggressive. And in those markets, long straddles worked very well, but it's certainly a very selective strategy. Dan, you had mentioned earlier when we were talking about trading options in earnings season that 5% of your trades are long straddle trades. So what do you have to say here for Aaron? When do you use this polarizing strategy, sir?
Well, less than 5% of them on my earnings trades. And I was just looking at the report on theoptionsinsider.com, Matt's most recent one. And this is very interesting. Looks like straddles are better at the beginning of earnings season, and calendars tend to be better towards the end of earnings season. So that's pretty telling, I think. And Matt, correct me if I got that wrong. That's pretty telling, because there's not a blanket statement that I could make where you say, hey, when the VIX is this is when you buy straddles. We're really looking for very specific opportunities where we expect the market to move more than the amount of volatility that's priced into the options. And, even if you get that volatility, but it's sort of back and forth volatility, you can still end up losing on that straddle. So what I love to tell people all the time is, look, if you trade straddles, first of all, they're hard, and you should expect to lose more often than you win. But your winners can be, you can hit some pretty big home runs. So, get in there, do a lot of volatility analysis, look for that, those real sweet spot scenarios where you have reason to believe the market's going to move more than what's priced into the options. That's the big gist of it.
Need that bang for your buck. Matt, anything to add here from Mr. Aaron, who wants to know when you would condone using this very, as he puts it, polarizing strategy, sir?
Yeah, I mean, good point by Dan. I didn't really look at it that closely, but we do break down when our signals are coming out of buying straddles, and so it looks like, yeah, week 1 and week 2 are the best, and week 4 is kind of the worst. And interestingly, that's week 1 is usually the bigger names with lower vol, so you are getting more bang for your buck. And I'll just mention briefly, we have a lot of people that are looking at zero DTE straddles in SPX. And so we did two studies. We did one where we bought it the day before, 14 minutes before the close, the day before many of these expirations, and held it until expiration. And then we did, we still have construction going on, expanding ORATs here. And then, and the other one is just holding a straddle for the last 14 minutes of the trading day. And interestingly, this year has been pretty crazy. So buying that straddle the day before was quite profitable, holding it to expiration. Whereas the last 14 minutes was not very good. So a couple of interesting 0 DTE and 1 DTE, and also some earnings straddles. So yeah, it is polarizing, and straddles are tough, but back test it and get a little bit more confidence that way, Mark.
Everybody's hawking this 0 days to expiration now. The zero DTE. Everyone's inundating me. What about zero DTE? It's the hot new thing, apparently. Someone out there is really hawking this stuff. So, yes, all the rage these days. Everyone wants to do everything expiration day, Matt. No one's got any patience anymore.
Well, we loved expirations when we were traders.
We did.
And now everyone loves to trade them. And we get so many comments on that. And, if you look at where the volume is, it's all in those short dated. I mean, that was genius to have every day is an expiration, Mark.
Every day is an expiration partay over there, if you really want it to be. All right. Are you in the zero DTE club? I know quite a few of you are out there, listeners. Hit us up. Someone's hitting us up recently about zero DTE butterflies, which again sounds like a crazy town to me, but the crazier things have happened. They could work, but you're rolling a lot of dice there with that kind of fun. All right, let's keep on rolling here. We got time let's see if we could squeeze on a few. Let's go to this one from Kunal. Coming in from India, he says, "Hello, team. Big fan. Tremendous work. Congratulations from India. Thank you for this long run simplifying options." Well, thank you, Kunal. He says, "I have listened to the adjustment episodes, and I have a scenario. Should I start with a bearish view and buy an at-the-money naked put?" So, listeners, he's bearish on an underlying. He decides to buy a put on it. And he says, "And then the markets become bullish, and I decide to change my position to a bull put spread via a diagonal calendar by selling the next month higher in the money option to get that credit." So listeners, he's long an at the money put. The markets turn against him. They decide to start moving north, and he changes his outlook and decides to sell going out a month and selling a diagonal now in the money put and trying to make that now a credit spread, collecting a credit to do that. He says, "Do you see a flaw in this execution? Is there a better option? Have a great weekend. Thanks, Kunal." Well, thanks for the love from India. We always love to see our international listeners writing in here on the show. This is interesting. Adjustments. Again, we've done a lot of episodes on them. We probably will do many more. Maybe we'll invite Matt back to do an all adjustments all the time episode here. But there are a lot of ways to skin the cat. The first take on this, obviously, is going to be you had a bearish view, and now everything has changed. So maybe you're better off just taking what you have left of that put, selling it, and then reestablishing something else. When you start trying to force things like this, and you're trying to find a way to get a credit out of this, chances are you might not even get a credit to do this. So you're selling the spread for a very nominal amount at that point, which is never ideal. Also, diagonals can be tricky. We talked about calendars and time spreads on this show many times in the past. Those are more of an options 201, even maybe a 301 type strategy. So you need to know what you're doing if you're going to start legging into diagonals. So I would probably, in this scenario, live to fight another day, take what you have left of that put, and then maybe look to reestablish. Maybe you want to do a bull put spread instead in the same expiration month, a little bit more straightforward of a trade. And then you could pick and choose whatever strikes you want. You're not tied to this other put that you bought already, and that's kind of forcing you to maybe make a trade you don't want. But I'm curious. I want to go around the horn. Maybe we'll start with Mr. Matt. You're always out there back testing and doing a lot of different work like this. People are coming to you over there at ORATS with questions just like this all the time. I'm sure you haven't back tested this specific scenario unless you're extremely speedy. I don't know. But what are your thoughts here for Kunal? He buys a put on an underlying. The stock turns against him. And instead of getting out, he wants to leg into a diagonal and try to turn it into a diagonal credit put spread. Sir, what do you think?
Well, first of all, it's not that margin efficient since you're essentially just now naked a put out farther. If it were in the same month, just a little bit more in the money, you'd still you'll still most likely get a credit or at least a break even on that. So you might want to think about that. There are good back tests that move the unchallenged side. So let's just say you have a short strangle, for example. As it's going up towards the call, you could then roll the put up and keep rolling the put up and get more and more of a credit. So that that's been a decent back test. And we are coming out with signals in ORATs to help us kind of know when is the better time than not to do a roll like that. But I would see just a couple of things wrong with this. If are you really that bearish and then you turn bullish right away? I would keep it in the same month for margin efficiency. Or who knows, maybe even sell a closer, turn that into a calendar. So you have the at the money naked put that you're long, and sell a at the money put that's now turned it into a calendar. So I'd be more inclined to do those types of adjustments rather than because once you go out that far, you're now the margin is a killer out there. So those are the things that I would think about, Kunal.
People always forget about the margin requirements. When you start getting outside your expiration month, that kind of thing happens. Look at your broker from your broker's perspective. Now you're just selling a put, and that other put's going to be gone. It's not covered, so you're just going to tie up a whole bunch of margin for that put you're selling there, Kunal. So if you suddenly say, wait a minute, where'd all my options buying power go? It went into this trade. So that's a good point that is often overlooked. Mr. Dan, anything to add here for our fan here from India, Kunal? He's got a put. It's going against him. What do you think you should do?
Yeah, I mean, just two things. One is you always want to be careful of being fickle. You got to, when you come up with a forecast in trading, the only reason you should put on a trade and put your money behind it is because you feel statistically strongly about it. Okay. And the other thing is if you sell a put and then the stock goes up and then you buy another put, whether it's, he's selling. He's
long a put and then his stock starts rallying.
That's right. Yeah, if you're long a put and then the stock starts rallying and then you sell a put, whichever expiration it's in, you're effectively legging into, a bear put spread or a bear diagonal put spread at an unfavorable price, one that's kind of statistically against you because you're buying the option when it's high and selling the other option when it's low. So you're just putting it on at a way worse price than you could have originally. So, just keep that kind of stuff in mind too.
All right. Great questions, everybody. We'll get to more of you on one of our next upcoming All Questions Considered episode. Keep them coming from all around the globe. We love to hear from all of you folks out there. Unfortunately, that music means we've come to the conclusion of an epic, wide-ranging, just super fun episode of Options Bootcamp. Mr. Matt, thank you for joining us in our first roll call in forever. You may regret it. You did a pretty good job, so we may have to invite you back, sir.
This is a lot of fun. You and Dan, great knowledge and great service that you're putting out there. I'm glad to be a part of it, Mark.
Well, you could say that about me. Dan, I don't know. I mean, that's a little bit more questionable. He's highly contentious, like the straddle, But Mr. Matt, if folks are intrigued, obviously they can go to the Options Insider to check out the reports we talked about. But you guys have a whole bunch of cool stuff cooking over there at ORATs. Why don't you lay it down for the folks, sir?
Yeah, I mean, our new dashboard is killer. I mean, you could find out all the stuff on earnings, scanning. We have stock scanner. We're building a signal builder. That's going to be a lot of fun. Give you the signals when to buy and sell. If ball's going up, if contango's going down, whatever. An analyzer with a really cool options chain showing where your trades are. So there's just a lot of really neat stuff. You could see some of the screenshots on YouTube on our earnings videos that we got, and of course at Option Insider. We put most everything there. So check us out at orats.com. A lot of great stuff.
I need to deep dive into that dashboard myself. You've added a lot of layers of paint over there, even since the last time I talked to you. So a lot of cool stuff there, listeners. Check it out for yourselves. Orats.com, ORATS.com. That stands for Options Research and Technology Service. You can kick the tires on this options scanner. Also, awesome back testers there and everything else. Check it out for yourselves. Orats.com is the place to go. Also, give them a follow if you're interested in this kind of data you want to maybe see more of it in between his appearances on the network, give him a follow over there on Twitter at OptionRats. All one word. Very memorable handle. Easy to find over there. And Mr. Dan, if folks have questions about trading options around earnings or anything else, where should they go? What should they do, sir?
Well, I actually have an ebook on trading options around earnings, and you can just go to markettaker.com/earnings. 2 T's in a row, markettaker.com/earnings. And if you like this episode, you're going to love that ebook.
There you go, markettaker.com/earnings. Don't forget the second T stands for Theta, markettaker.com. That's going to do it for us on the live today. Brian will be coming up later. He'll be live to tape as usual. I can only force him into the huddle so many times. That's all his compliance will allow, listeners. But if you have questions for him, you know where to get at him over there. If you're listening to Options Bootcamp and you're not listening to Options Playbook Radio, very much a sister show to this, you're doing yourself a disservice. In fact, if you haven't upgraded to listen to the full network, you're doing yourself a disservice. There's a ton of great content there. I know a lot of you come in via Bootcamp. There's a lot more there. So wherever you're listening to this, make sure, of course, you upgrade to the full network. Usually a couple of shows coming at you every day. Then back again tomorrow for all you pro folks and everybody else on the on-demand side with This Week in Futures Options, Episode 2, the Option Block. Friday, got a trifecta of content. Man, my voice is going to be tired this week. Got Vol Views at noon. Then for all you pro folks, we've got Options Oddities coming up after Vol Views. And then immediately after that, we've got another second of 2 pro Q&As for you folks this week with Eric Kovalak from Vellum Capital talking all things crypto. So that should be really fun. Where do you go if you want to join up for all that fun stuff, listeners? TheOptionsInsider.com/pro is the place to go to learn more. We got to get on out of here, but we'll be back again next week. Another great episode of Options Bootcamp. Stay safe out there, everybody.
You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.